Mike, thank you for joining us today. I remember a year and 3 months ago, I was covering your deal to sell XL to AXA. Oh, and by the way, this is Mike McGavick, the CEO of XL, and now is an advisor to AXA in the transition period. Can you talk to us a little bit about the rationale for the deal and the challenges maybe in integration afterwards? What exactly are you advising on now?
Sure. So a couple of things. First of all, AXA XL deal was a part of a larger trend, I think, and that is that scale is still winning in insurance and becoming, I think, more important, not less important. So as we looked at ourselves, so we were kind of a 15 billion revenue company, very large presence in both commercial, specialty, and reinsurance. And yet we could tell that there were opportunities that we couldn't play at the right level because we just weren't considered large enough. And we tried to fix that by buying Catlin and doing other acquisitions, but we realized in the end that we were going to be better off creating value through joining forces with AXA. We think it was a great deal for our shareholders, a great deal for our people, because we created an entirely new division around their talent. So they got a great balance sheet to work from, the ability to do more of the things we did well, but at scale. So that was the biggest driver by far.
It's funny you say scale is such an important thing. You also created an innovation arm, right?
Sure.
And you invested in smaller companies as well, most notably Lemonade, although at the time that was one of the biggest investments in venture at the time.
Right.
Talk to us a little bit about why you created that.
So first of all, the idea that insurance tends to gravitate towards scale shouldn't discourage anybody from starting up good ideas. The reality is, over time, my belief is that as long as the idea contributes to the insurance ecosystem, the small guys will do just fine. And eventually, if they turn out to be a very forceful or successful, they'll wind up eventually integrated into one of the larger firms.
XL started as a startup itself.
XL was a startup in 1986 to solve for the lack of liability insurance availability.
So why Lemonade, right? There was a very big bet at the time. What were some of the challenges about making that kind of wager on one company and bringing in partners from different places also?
Well, you have to go back. So why did we get into venture business at all? Innovation is such a hard thing to do, particularly in a corporate setting. You've got all kinds of internal jealousies and stuff that gets in the way of great breakthrough ideas that might injure an existing business. So we felt we had to tackle that in 3 different ways. Lots of incentives for individuals within the company to innovate, an innovation team within the company to work on specific projects that we saw as valuable, and then to invest in firms outside of the company that might show us the path to either a better use of technology, a better idea, a bigger idea. Lemonade was a perfect example of that. We felt that they were really onto something in the way they were going to structure and market the business. And we felt they were a good bet from a reinsurance perspective. So we were able to make an investment and also come into the team that was reinsuring them in the back end. That kind of offset the risk of the investment to a degree. We could keep an eye on what was really going on and provide some counsel to them. All of that, I think, played out exactly as it should.
So you mentioned that there was an opportunity maybe to market things differently. I mean, what did they do right at the beginning until now, and what are the challenges moving ahead from now until the next 5 years?
Well, look, you know, I'm not even an employee of AXA anymore, much less all we were as an investor of Lemonade. I'd really leave that to Lemonade to talk through. But I remember thinking that the kind of market they were focused on and the way they were able to bring new customers into insurance to expand the marketplace, that struck me as a very powerful idea, because if there's anything that InsurTech stands to gain from, it's helping solve the rampant and bizarre problem of underinsurance around the world and even in the most industrialized economy in the world.
Underinsurance, I'm glad you hit on that. Underinsurance is something you've spoken about a lot. Microinsurance is another way that you sought to address this problem. What are some of the more innovative solutions you've seen among your peers and the incumbents in terms of how they are addressing that problem?
Well, the biggest problem is kind of the last mile problem. In most places plagued by underinsurance, first of all, underinsurance is a problem everywhere, as I see it. But worst of all, underinsurance is fundamentally destructive to the poorest and the weakest amongst us. And that's the real sick lesson of underinsurance, is we aren't providing resilience to people who really need it. And the biggest challenge has been the cost of that last mile of providing the insurance. So what we're seeing is new companies and new ideas, mainly built around telephony, to try and get microinsurance policies able to be established, triggered, paid all through the phone, which is often the banking means in certain parts of the world. We're an investor in such companies as well. And all of us are trying to find a way to really get that done. If you can start creating resilience in societies that desperately need it. But as it stands, if you see news about a cyclone in the Philippines, you can predict that only 1% of that economic loss will be insured. I think that is practically criminal. And if you looked at the floods in Houston, it was overwhelmingly the poorest who suffered by lack of insurance and lack of products that really take care of them. And if you look at Superstorm Sandy, which only 50% of the economic loss was insured, despite the fact that it hit the most insured square mile in the planet.
And you're talking about two cities that are not considered normally underinsured.
They're considered, yeah, we all think they're well penetrated. Well, they're well penetrated in the products we understand today. But if you take flood, which I think is one of the great opportunities for investment and innovation, the U.S. flood program is a joke. It's a joke, and people suffer because of it.
So all of these places that you're saying are underinsured, who do you think are the most likely players to be impacting these markets? Are these the newer players that are emerging, or are they the big established companies like AXA that are already trying to also innovate as well?
Yeah, it's going to be a combination. I think some of the breakthrough ideas are going to be tech-centric, and wouldn't surprise me if it came from anywhere. But driving it into the market and making it succeed in the long run, I think that's generally going to have to be a partnership with a large established operation that really has the infrastructure to push it all the way out. So I think it's going to be combinations of ideas from perhaps the people in this room, combined with the kind of firepower of an AXA and Allianz, those guys.
So you mentioned underinsurance. Are there other areas that you're seeing that are ripe for innovation in the insurance market? What are kind of the coolest things that you're seeing people address right now that have some room for success?
Yeah, so my biggest theme would be underinsurance, but in reality, there are three ideas that I think drive all of the guys who are really making progress. Number one, attacking the cost structure of insurance. Think about commercial insurance. The customer's buying claims payments, right? The customer's getting 60 cents out of the dollar. That 40 cents, it feels like it's all waste. Now, it isn't all waste, but it sure as hell isn't what the consumer is expecting. And anything that attacks that 40 cents and makes the product more efficient is going to be a winning idea, and people are going to race to it. The second thing is, does it create more insight? Can underwriters do their jobs better? Can we understand risk more granularly so we can create better products that are more efficient and more accurately priced? That's a huge opportunity area. And then the final thing, and this is the thing I think about the most, and I think Lemonade's success is partly in this space, but it's really about, can you create a model that attacks the problem of trust? Insurers are inherently distrusted. There's been many failures and bad stories over the years. This is why we're so heavily regulated, to create trust in the system. But the reality is, anything that can create a product that is more trustworthy than the consumer thinks of it today is where you're going to have big breakthroughs. And I'll give you an example. The marketplace is being completely reinvented by the way in which catastrophe insurance was modeled, which was a technology breakthrough, and delivered and specified to zip codes. Because of that, it created modeling that was trusted enough that non-insurers were willing to back this. And this brought a whole wave of additional capital into the industry. Now, as an industry incumbent, I suppose I should be sad about that because it drove pricing into the toilet, but consumers benefited. We have more reliable models, and it was backed by a parametric trigger. So the clients and the investors weren't afraid to be involved because of the notorious claims process. They thought it was obvious when it's going to get paid. It's going to get paid immediately because there's funds waiting. And that is a very trustworthy change to the model. And it has rewritten the game for everybody. People who can find ideas that break down the distrust in the industry will be the biggest winners in the long run, and it's the biggest need of all.
So you and AXA CEO Thomas Buberl have said that this is the golden age of insurance. Can you tell us exactly why that is, and what really is the opportunity to grasp here?
Yeah, I really do feel that way, and I know Thomas does as well. It's part of why we got excited in putting the companies together. I think the reality is that the breakthroughs that have been coming for the last few years out of the insurtech space are contributing to attacking problems that have dogged us forever. And as a result, we're going to be able to turn around the fact that insurance, and particularly commercial insurance, has been becoming less relevant to society for a long time. You know, our share of GDP used to grow exactly with the growth in overall GDP because we're a shadow. We're there to support the values that are created. And yet that stopped happening about a decade ago.
So you're having a pretty optimistic view on something that's not going right so far.
Yeah.
So why is it exactly that the industry is not growing to the pace of GDP? What are we missing here?
I think there are two things, and you and I talked about one of them before. I'll never forget, I had one of those aha moments. I was sitting at a conference, this is right after I got to Excel, and the speakers that day were Warren Buffett and Marc Andreessen. And they gave entirely different perspectives on investing. Back then, Warren wasn't investing in tech companies because he said he didn't understand it, but he understand physical things, he said. I like to play with trains, he said, and all this funny stuff. Andreessen got up and said, and he pulled out his smartphone and he said, we constantly look for groups, often of kids, who are developing a product that will make an app that will go on this phone and destroy a physical category of economic activity. And my brain went, got it. So, phone itself, your camera, your video camera, your health monitoring device, your GPS, go on and on and on. And think of all of those as things that used to be built and be on a shelf in a store and that you would buy and take home. And now they're $1 or free on your phone. There's not much value in insuring the dollar app. In fact, there's none. There's a little bit of value in insuring cell phones. But otherwise, all those physical categories of activity, all of which we used to insure, are, as they say, blown to bits. And that's part of it, is there are declining physical activities, and more of the value is in the intellectual space, in the coding space, and those are proving very difficult to insure. Very difficult.
I'm so glad you brought this up. When you first brought that up was 4 years ago. I'll never forget where you were in. It was right after Ping An bought the Waldorf Astoria, and you were giving a speech to international insurance executives, and all of them were like, "Who is Marc Andreessen?" And so it was, at the time, it was a thing. And 4 years later, we are still seeing a lot of the same challenges. And so I'm wondering, to what extent has the industry started? How did you at Excel, from that point to now, start to address that exact challenge?
Well, we started looking at, there are startups out there. Science has done a nice job of creating technology that tries to understand when somebody's under attack and create defenses for that. I think that's been very clever and well respected. But we took it on as an insurance problem and wound up taking one of the best executives away from another company to help build a cyber insurance team. And I will tell you, the cyber insurance products that are out there right now are, to my eye, very valuable and nowhere near what's needed, all at the same time. Because if there was ever a connectedness risk, it's cyber. So the fear of total limits being blown away by a mega event keeps everybody writing small limit policies, and even the reinsurers only taking on so much connected risk. We're going to have to figure out a way to attack that, and I'm fully believing that eventually it'll be a combination of things. Number one, forever, more data, more data, more data. We've got to understand it more granularly. And you've got to create safe zones to create that data, much in the way we create federalized data around automobile accidents and all the rest. We have to do the same thing here, because people don't share everything about being hacked, because they don't want to attract more hacking. It's fairly logical, but we need anonymized data that really understands what's really happening. There's some safe houses already created out there. There needs to be more. That's the second thing we need, is more anonymized data. The third thing we need is a new legal framework. Imagine how long it's going to take to establish who's to blame when someone has a cyber failure. Is it the company for not managing itself well? Is it the services provider who was theoretically insulated in the company? Is it the manufacturer of the software that had the hole in it that got exploited? We're going to wind up debating and litigating these ideas forever. We need to come up with a liability theory that prevents it from being a lawyer's win and a society loss. And then finally, we need a backstop. If the big thing happens, that's a governmental risk, and the government's going to have to take a stake in that risk. If we do those things, I think there'll be a real cyber market and not a fringe cyber market.
Do you have a little concern, as it pertains to cyber and some of these other new areas of technology really to insure, do you have a fear that the industry doesn't quite understand the technology industry that is, enough to price it properly?
Yes, that is the fundamental problem. And so what you do is you price it strongly. You make, I once was told when I was first in the business, because I grew up in a whole different life, and the best advice I ever got was, look, the profit margin in insurance is the difference between the fear of something happening and the reality of something happening. And that's totally true in cyber, right? So you can price it pretty strong, but you really don't know if you're making profit because someday there's going to be some big event and you're going to get caught up to it, and it could be quite connected and could go all across your whole book. So we wind up writing strongly priced, but not precisely priced products, and we don't write big limits because we're terrified.
Do you predict major losses across the industry in cyber?
Eventually.
Do you think that, we talked about cyber a little bit, but another big area that a lot of people are having a lot of hard times covering is the shared economy. Mm-hmm. And I'm wondering if that's another place that's ripe for non-traditional insurance players to come in.
There are, and one of the things is I'm lousy at remembering all of the names of all the things we invest in, but here I do. Slice is one of our investments where they are working on shared economy insurance solutions, which is related to the microinsurance, individualized policy stuff, and related, of course, to the idea that there's been moves to create captives to try and, but all that winds up in reinsurance land anyway. So it's traditional products backed by front-end marketing, but captives are still good. We see Uber and Lyft fooling around with that, and we see folks. We were talking about Tesla trying to put it into the product somehow. Until they are fully automatic, I don't quite understand how that's going to work. That's been tried over and over and over, never got off the ground. But eventually, I suppose it'll work.
Well, actually, speaking of Tesla a little bit, can you talk to us a little bit about your own efforts to try to capture that market or the heart of what Tesla's trying to do? Yeah,
we've done those kinds of, we've attempted those kinds of partners. We're large insurers of the world's largest automotive manufacturers and many of their parts suppliers. So it was always a logical relationship, and we would try to come up with how could you embed it in the price of the car? How could you make it the car's insurance instead of the driver's insurance? And every time we did it, we wound up hung up on the idea that as long as the liability scheme is about the individual driver, it's very hard to embed in the product itself because you don't really at the point of sale want to be underwriting the driver's capability. That's going to be a turnoff to that buyer, and it's going to drive the price into volatility. So it's better, they eventually concluded it was better to have that as a third-party product. When, and I say when because I'm a full-on believer, it's got to happen, when cars are fully automated, however that evolves, that will be a systems risk, not a driver risk. And that should radically change who is providing insurance and why and through what means. And I think it'll become very large policies, either embedded in the system creator, in the technology player, or in the manufacturer, somewhere in there.
So back to the shared economy just for a second, because you had mentioned Slice doing innovative things in that space. We're still seeing large captive insurance vehicles from Uber, right, for example. Right. And so, is captive the way to go, or are there kind of other things that can be done to try to address some of the massive liability issues in some of these shared economy companies?
Right, and again, I think the end state of that will be things that are embedded in the systems risk. But it has to be fully mature and automated before you can get to that. As long as there's these individual risks, you're going to have to do individualized policies around the person who takes an Airbnb or the renter of an Airbnb space, provider of it. All of those have different risk characteristics, and that's why it creates the opportunities for companies like Slice to come in with kind of individually generated follow-on to the individual transactions. I think that's a very clever space. But again, those always wind up being, in the end, connected to the traditional insurance ecosystem, one way or the other.
So when I first started covering insurance, startup meant hedge fund starting a Bermuda insurance company. 2 years later, you see venture capital entering the insurance space with InsurTech and whatnot. And so you had a really interesting history in how you were accepted in this space also. Can you talk a little bit about your history with trying to pair up with venture capital for the first time? Yeah,
so I still remember, the guy who, that I know, Martha's here from our Innovate team, but Tom Hutton and I have been friends and colleagues in various enterprises for a long time. Tom's a long-time investor in FinTech and InsurTech. And Tom, we had a lovely meeting out in Idaho, and one of those late wine ones that solves all the world's problems. And we figured out, we need to have our own fund. We can't get all the innovation done internally, and you're the right person to go lead it. And he didn't want to call it XL Innovate. And we wanted it for branding purposes, and we thought it was good to establish there was a big balance sheet behind us. But Tom came back and reported that the seed investors, the investors over in Silicon Valley, didn't want to participate with corporate capital. They wanted it to be all entrepreneurial-centric capital. And so we had to, and Lemonade wound up being the test case because they came to us and we came to design a new reinsurance model for them, which was very valuable for them. And we said, but we will only do so with an investment stake. And the Silicon guys didn't want us to be in and all that stuff. And I think, though, that game has completely changed now. I'm pretty sure, Marla shared it with me, 40% of the deals done last year had some kind of a strategic investment partner. And I think that's purely reality. And I'll give you an illustration of why. I was at Davos, where I was co-chairing the financial governors of Davos, which is just the CEOs from the financial industries. And they always select one of the big bankers, and then anybody from asset management and insurance. We're all the little, the bastard children of finance. And so I was sitting at the big boys table that year. And I was sitting next to one of the biggest bankers in the world. And across the table was a guy from PayPal. And he was going on and on about how they were going to rule the world and blah, 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 blah. And as the lunch wrapped up, I won't repeat his words exactly, but the banker leaned over to me, if this guy doesn't shut up, I'm buying his company after lunch. And I was glad I had my Depends on. I went upstairs and looked up the market caps, and he could have snapped his fingers and bought it. And that was a reminder to me that while these things are very valuable and you can create enormous wealth, if the big guys, the entrenched guys, find it valuable, they will incorporate it, they'll imitate it, or they'll just corner you off and buy you up. And there's nothing wrong with that because it improves the whole ecosystem.
So, fast forward a little bit, he didn't buy the company, right?
He did.
You just sold your company, so financial services deals can be pretty tough.
Super complex. Yeah.
So what happens to this new generation of companies rising? Do they come to be the biggest companies in insurance of tomorrow, or do you see a big consolidation play happening at some point?
Yeah, I think it's almost the idea that someone's going to run the table and become the next Allstate or something strikes me as highly unlikely. The person sitting in the chair before me, the regulatory community, they're very hicky about this. Capital is just a hard to come by asset in the end, and managing huge volumes of capital is a huge challenge. The infrastructure, the regulatory morass, it's state by state, it's country by country. When you add all of those barriers up, in the end, someone who makes a great run, their best outcome is probably to be incorporated into a larger company. And so I would expect that to be the end game for most folks. Now, service providers, they can go a long ways because the service world, again, in an industry where 40 cents on the dollar is arguably wasted from the consumer's point of view, great service providers can break out and displace people all the time. And I look at the tech providers that we used back when I was working at CNN. I looked at tech providers we were working with at XL. They were almost all different and all of different roots. And I think that the service providers is a longer play if you want it to be, although, watch out for the Accentures and the others who'll be goggling them up too. So.
Well, speaking of service and technology in insurance, I'm wondering if you look at the headcount moving forward and the talent base moving forward, what is it going to look like? And are there areas that can be automated within the big insurance companies significantly?
Yeah, there's still tons of areas that could be automated, and they're kind of slowly working it through. I think the idea of insurance companies being soup to nuts providers of their own services are dwindling. There's going to be a lot more outsourcing or solutions that are provided that get rid of whole swaths of internal work. The one thing that I think will continue to be valuable, particularly in specialty insurance, is the leading edge underwriters are going to be a combination of technology and old-fashioned insurance knowledge. And I don't think that model changes for a long time. But I remember reading once that the easiest job in an insurance company to automate was CEO, which I do believe, by the way, because we're just processors of input, and that makes sense to me that we should be out of the building. But the underwriters of tomorrow are going to be great at harnessing what technology can give them for insight, and then add that special juice that makes underwriters such unusual good traders. I don't think that model goes away. It just gets expressed in new ways.
So we started talking a little bit about XL Innovate. I think it's important to get to. It's been reported that AXA will be freezing its investment in XL Innovate. So what is that supposed to look like moving forward? Can you tell us a little bit about that rationale?
Yeah, the only thing I can say for sure, look, AXA had a huge, and I think there's some of the folks here, but AXA has a huge investment arm centered in this space already. So there wasn't, relative to, and this was another one of our observations about scale, you know, we couldn't play at their level, even though we think we had the best pipeline in the industry because of Tom and Martha, and just some of the early good bets tend to beget more interest because everybody wants to be validated by you and all that. And I think while we had one of the best input mechanisms in the industry, AXA, as big companies do, tended to value what they had built more than what they had just bought. And as a result, wanted to consolidate it all. I think Tom and Martha and the others are so valuable that that wasn't the right thing to do. And I think they'll allow Tom to, and the rest to manage the existing portfolio, which is a great portfolio. I think there's going to be, it's far beyond limited. And then, you know, probably reemerge in some other fashion. So there's been a lot of interest in investing in them. I think those who do will do great. Whether Tom chooses to do that, I have no idea. So that's for them to address.
And something to end on. What's next for you? Are you going to stay in insurance? You used to have a political career.
Yeah, well, that was short-lived. No, my wife made me promise when the deal came down that I would take a year off and stay off of planes. I'm doing my best. And
except for this.
Except for this. Well, I love this topic. This is a cool topic. But I imagine I'll stay around the industry in some fashion, but I will not be leading large companies again. Having done 3 of those gigs, I think I've had enough.
Okay. Thank you so much, Mike. I really appreciate it. Welcome our next panel, Alex Morel of Business